It was the last week of March, 2021. Somewhere on Wall Street, phones were ringing off the hook, not the kind of ringing that means a deal, the kind that means a disaster. Prime brokerage desks at Morgan Stanley, Goldman Sachs, Credit Suisse, Deutsche Bank, all calling the same counterparty, all getting the same answer. There was no answer. A family office called Archegos Capital Management had just imploded, silently, catastrophically, with almost no warning to anyone. In 48 hours, more than $20 billion vanished from the personal fortune of one man. His name was Bill Hwang. He wasn't a household name. He wasn't on magazine covers. He wasn't giving TED talks about the future of finance. He was operating in the shadows, building one of the most concentrated, most leveraged, most dangerous positions in modern financial history, and the banks that handed him the rope had no idea what he was doing with it. This is the story of Archegos Capital, the greatest single loss of personal wealth in recorded financial history. Bill Hwang grew up in South Korea. His father was a pastor. He immigrated to the United States, studied economics at UCLA, then earned his MBA from Carnegie Mellon. That biography doesn't scream Wall Street legend. But what happened next does. Hwang landed a job with Julian Robertson, the founder of Tiger Management, one of the most celebrated hedge funds in American history. Robertson was known for identifying talent. His protégés became known as Tiger Cubs. They went on to run some of the most successful funds on the planet. Hwang was one of them. In 2001, he launched his own fund, Tiger Asia Management. It focused on Asian equity markets, and for years, it performed brilliantly. According to SEC filings and court documents, Tiger Asia grew to manage approximately $8 billion at its peak. Hwang had the Midas touch. He had the pedigree. He had the connections. But then, Tiger Asia ran into a wall. In 2012, Tiger Asia pleaded guilty to federal wire fraud charges. The firm had traded on inside information about Chinese bank stocks. According to the Department of Justice, Tiger Asia used material non-public information obtained from share placement transactions. Hwang personally paid $44 million to settle related civil charges with the SEC. He was barred from managing outside investor money for a period. For most people, that's the end of the story. For Bill Hwang, it was just intermission. In 2013, he converted Tiger Asia into a family office. He called it Archegos Capital Management. A family office manages only the founder's personal wealth. No outside investors, far less regulatory scrutiny. The SEC largely left it alone, and Hwang started again. Here's what a family office doesn't have to do. It doesn't have to register as an investment advisor with the SEC. If it manages only family money, it doesn't have to disclose its positions publicly. It doesn't have to file 13F reports, the quarterly documents that reveal what major investors hold. Hwang had found a legal structure that let him operate with near total invisibility, and he exploited it to an almost unimaginable degree. The instrument he used was called a total return swap. Here's how it worked. Instead of buying shares directly, Hwang would enter into agreements with prime brokers at major banks. The bank would buy the shares. Hwang would receive all the gains or losses. He'd put up a fraction of the total value as collateral, known as margin. This is leverage, and Hwang used it aggressively. According to court documents filed by the Department of Justice, Archegos was using leverage ratios of roughly 5-to-1. Some estimates by financial analysts suggested even higher in certain positions. That means for every $1 of his own money, he was controlling $5 of stock. Now multiply that across his entire portfolio. By early 2021, prosecutors alleged that Archegos had accumulated exposure, total notional exposure, of roughly $100 billion. $100 billion. This was a family office, run by one man, with one conviction already on his record. And here's the part that should make you grip your chair. Because Hwang was using total return swaps through multiple banks, no single bank could see the full picture. Morgan Stanley saw their slice. Goldman Sachs saw their slice. Credit Suisse, Nomura, UBS, Deutsche Bank, each saw their piece. Nobody saw the whole board, according to prosecutors. Hwang also allegedly engaged in a scheme to artificially inflate the prices of certain stocks he held by accumulating enormous concentrated positions in a small number of companies. He could move prices upward. Higher prices meant higher collateral values. Higher collateral values meant he could borrow even more. Court documents revealed the stocks at the center of this alleged scheme included Viacom CBS, now known as Paramount Global, Discovery Communications, GSX Techedu, Baidu, and several others. Hwang reportedly held positions representing 20 to 40% of the publicly available float in some of these stocks. That kind of concentration doesn't just create risk, it creates a trap, and in March of 2021, the trap sprang. The trigger was Viacom CBS. On March 22, 2021, Viacom CBS announced a stock offering. They were going to sell new shares to raise capital. This is standard corporate finance. Companies do it all the time. But for Bill Hwang, it was a catastrophe in slow motion. New share issuance dilutes existing shareholders. It typically pushes the stock price down. Viacom CBS shares had been trading at extraordinarily elevated levels, partly, according to prosecutors, because of Hwang's own buying. When the offering was announced, the stock began to fall, and when Viacom CBS fell, everything around it started to crack. Archegos held massive positions in a tight cluster of stocks. When one fell, the margin calls started. A margin call is when your broker demands you put up more collateral because the value of your positions has dropped below a required threshold. Hwang couldn't cover them, or wouldn't. The exact circumstances remain disputed. What happened next is one of the most dramatic episodes in modern financial history. According to reporting by the Wall Street Journal and Bloomberg, Goldman Sachs moved first. On Friday, March 26, 2021, Goldman Sachs began liquidating Archegos positions. They sold blocks of shares worth billions of dollars in pre-market trading. Before most of Wall Street was even awake, Morgan Stanley reportedly followed. By the time the market opened, billions of dollars of stock were hitting the tape simultaneously. Prices collapsed. Viacom CBS fell more than 50% in days. Discovery fell similarly. GSX cratered. Baidu dropped hard. The banks that had moved first, Goldman and Morgan Stanley, got out relatively clean. The banks that hesitated, Credit Suisse and Nomura, were devastated. Credit Suisse, the 165-year-old Swiss banking institution, lost approximately $5.5 billion. According to Credit Suisse's own disclosures, it was the single largest loss in the bank's modern history from a single client relationship. Nomura, Japan's largest brokerage, lost approximately $2.9 billion, and Bill Hwang's personal fortune, estimated at over $20 billion at its peak, evaporated in roughly 48 hours. No press conference, no statement, no explanation, just silence and wreckage spread across 4 continents. You now know how $20 billion disappeared in 2 days, but here's what you don't know yet. What did the banks know? And when did they know it? Were there internal warnings that were ignored? Were there compliance officers who raised red flags and were overruled? And most critically, what happened to Bill Hwang when prosecutors finally came knocking? The answer involves a criminal trial, a fraud conviction, and a question about whether the biggest banks in the world were complicit or just catastrophically naive. Keep watching. For over a year after the collapse, Hwang said almost nothing publicly. Archegos issued a brief statement expressing regret. That was it. Then, in April 2022, the other shoe dropped. The Department of Justice unsealed an indictment. Bill Hwang was charged with racketeering conspiracy, securities fraud, and wire fraud. His former chief financial officer, Patrick Halligan, was charged alongside him. Prosecutors alleged that Hwang and Halligan had orchestrated a sophisticated scheme to manipulate stock prices and defraud banks. According to the indictment, Hwang allegedly lied to prime brokers about the size of his positions. He allegedly told banks he had a diversified portfolio, when in fact he was massively concentrated. He allegedly told banks he had limited his leverage, when the opposite was true. The DOJ alleged this was not recklessness, it was fraud, deliberate, calculated, sustained. Hwang pleaded not guilty. The trial began in May 2024 in the Southern District of New York. Prosecutors presented evidence that Hwang had directly orchestrated trading to prop up stock prices. In what they called a pump scheme, the defense argued that Hwang was a genuine believer in the stocks he held, that he wasn't manipulating, he was investing with conviction. On July 10, 2024, the jury returned its verdict. Bill Hwang was found guilty on 11 of the 11 counts he faced: racketeering, securities fraud, wire fraud, market manipulation, across the board, guilty. Patrick Halligan was convicted on 3 counts. Hwang faced a potential sentence of decades in prison. At the time of this script's preparation, sentencing had not yet been delivered. On the regulatory side, the SEC brought its own civil enforcement action. It charged Archegos and related entities with fraud. The SEC case highlighted a critical structural gap: the total return swap market. The instrument Hwang used to build his empire had almost no disclosure requirements. Regulators couldn't see what Hwang was doing because the law didn't require him to show them. In the aftermath of Archegos, regulators in the United States and internationally began examining whether prime brokerage oversight needed reform. The SEC proposed rules that would require large traders using swaps to disclose their positions more transparently. As of the time of this script, those proposals remained under debate in Washington. The banks paid their own price. Credit Suisse's losses from Archegos were so severe, they became part of a broader narrative of institutional mismanagement. Credit Suisse ultimately collapsed entirely in March 2023. It was acquired by UBS in an emergency rescue brokered by the Swiss government. Archegos alone did not cause Credit Suisse's fall, but financial analysts and journalists, including those at the Financial Times, argued it was a significant contributing wound. Nomura survived, but recorded its worst quarterly loss in decades because of Archegos. The prime brokers who escaped cleanest, Goldman Sachs and Morgan Stanley, faced questions about whether they had known more than they disclosed. Both denied any wrongdoing. Court documents revealed that in the days before the collapse, some banks had internally discussed whether Archegos' positions were sustainable. The decisions they made in those private conversations had billion-dollar consequences. Here is the uncomfortable truth this story reveals. Modern finance is built on opacity, not maliciously, structurally. The instruments exist, the loopholes exist, the regulatory gaps exist, and the people who understand them use them. Bill Hwang built a $100 billion empire using tools that were entirely legal, until, according to prosecutors, he allegedly started lying to the people providing them. But here's the question that lingers. The banks handed him the tools. The regulators permitted the structure. The disclosure rules had gaps wide enough to drive a freight train through. Hwang may be going to prison, but the system that allowed one man, with one fraud conviction already on his record, to accumulate $100 billion in hidden exposure is still largely intact. The rules around swaps disclosure changed slowly, partially, reluctantly. How many Bill Hwangs are operating right now in the dark, using the same instruments at the same scale? The honest answer is nobody knows, and that is the most unsettling part of this entire story. $20 billion gone in 48 hours, and the system that made it possible is still open for business. Here's the question I want you to answer in the comments below. Were the big banks victims of Bill Hwang, or were they willfully blind because the fees were too good to ask questions? Think about what you know now. The leverage, the concentration, the multiple counterparties, the prior conviction. At what point does a bank's due diligence failure stop being negligence and start being complicity? Drop your answer below. And if this channel is new to you, subscribe now. Every week we go inside the collapses, the frauds, and the hidden mechanics of money and power that the headlines never fully explain. The next one is coming, and it's bigger than this.